Welcome back. You're watching Stock Watch, and still with me rather, via Zoom is Wayne McCurrie from FNB Wealth and Investments and David Shapiro from Sasfin Securities. Gentlemen, good evening. Thank you for your time today. Are you guys good?
We are.
Yes,
Okay,
we're all here.
Just making sure.
Hello.
Just making sure. We've got quite a bit to get through today. Plenty of questions. Let's start off with the first one. It's from Anthony, and he says, can you ask your panel, if our economy grows next year, will our banks and financials go up from the levels where they are now? David, would you like to take that one?
Of course they'll go up. You know, I think the one thing that's held back our banks and financials, and when I say held back, is that there's been very little activity other than lending. And even lending has been quite controlled and muted. The banks have handled themselves incredibly well, but they really do well when the economy picks up and people start to do things, mergers and acquisitions, expansion, financing expansion, and so on. So yes, if the economy starts to grow and people feel confident and start spending money to expand their businesses, yes, then definitely they will do well. And I think we've all been waiting for that, for something around that.
Certainly, upbeat. When I imagine that, as a banker, this is an exciting time for you. What are the prospects of just better economic outcomes for us?
Well, look, I'm not directly involved with the bank and lending. I'm in the asset management side.
Yeah.
But yes, the answer is yes. I know First Rand's a 52-week high tonight, but the valuations on all the banks, put ABSA aside, I think there's a question later on about ABSA. All the bank valuations look decent. Capitec still looks extended, obviously, but for very good reasons that the share's expensive. When the economy picks up, as David said, you get loans coming out. But equally as important, when interest rates fall, you get less bad debt, you get less impairments. So it's actually quite geared up for the bank, for banks to make a bit of extra profits there. I mean, other than Capitec, the earnings growth has been mediocre. It's been single digit, sometimes low single digit, sometimes in ABSA's case, negative single digit growth. And the banks do need, but it's the same boat for a lot of South African incorporated shares. There's a lot of SA Inc. shares that are looking quite cheap, and it's all on the back. They'll run on the back of better growth next year, and it is going to be better. We'll see lower interest rates, hopefully a commodity upcycle. This two-pot retirement system will boost quite a bit of income into the economy. So it's all good for them. And, other than Capitec, the banks look at fairly good valuation levels.
Keen to get into our next question now. A lot of our questions today actually are about where. This one is another where question. Is it advisable to invest in the S&P 500 or the Euro EFF presently, or invest locally in the property sector? Wayne, you want to take this one?
Sure. Look, any investment must be part of a balanced portfolio. You're never just going to the S&P 500 or just going to South Africa. You've got to have a balanced portfolio. That is truly the only thing that protects you as an investor over time, is to have a very well-diversified portfolio. Now, personally, I would be tilting a little bit more towards South Africa now, simply because, the Rand's already strengthened quite a bit, but it'll probably strengthen a little bit more. We've just spoken about the SA economy doing well and SA Inc. shares doing well. The commodity shares should also do better on the back of lower global interest rates and hopefully some recovery in economic growth, especially in China. But would I invest all of my money in South African property? No, I wouldn't. I still think the property shares, still look very, very good value. But once again, coming back to my opening comment, yes, you can buy SA property. They still look good value. There's no particular problems there. They've got their debt levels nicely under control compared to where they were during COVID. But once again, part of a balanced portfolio, part of a diversified portfolio.
I think that segues perfectly into our next question, David. I'll ask you to take this one. It's about SA Inc. versus China. That's an interesting one. So SA Inc., ABSA, and retailers and others, those are undervalued. The viewer says, I would avoid Pick and Pay. It just won't battle ShopRite in my life. Okay, so that's more of a statement than a question. But then they say in China, there's Baidu, there's JD and the likes, all also very undervalued. Where do we go? Do we split the risk? Do we skew towards South Africa giving our rising tide, or do skew towards China, given the upside if it turns?
I would skew away from China. I think that there's still enormous problems there that are not being solved, stemming from the property and stemming from the way that the government handled COVID. They're still taking the companies down. And a company that we're very familiar with, Temu, if you look at PDD, which is Pinduoduo, whatever it is, they were down 30%. And I think just on competition meaning, battling for consumers, so on. And I still think that it's going to take time for China to find a level and to pick up. The big concern from us, and I was just looking today, is our commodity prices, which at the moment are also battling to find a balance. Today they're down simply because Chinese inventories are up, but that's the kind of volatility we get. So for the meantime, I'm just taking a step back from China. So if it had to come to a choice, I would lean towards those companies that he mentioned in South Africa. But for us, it's probably one of the obstacles that we do face in growth, simply because we're so heavily geared towards the commodity markets. But for the meantime, I'd rather look at South Africa than China.
Very interesting. Wayne, would you like to add to this one? I want to move on.
Yeah, look, I mean, a lot of these Chinese shares, the big JD, et cetera, I mean, they are seriously undervalued. But I do agree with David that you need some sort of catalyst out of China. I mean, these were the go-go shares. You need some sort of catalyst to get them going, but they are at very, very cheap levels.
Let's move on now to a question on Coronation. Please, can I have the panel's view on Coronation for the next 5 years? David, you chuckle, so let's ask you this one.
No one ever stays invested for 5 years. Okay. They always ask a question, but they measure their wealth on a minute-to-minute basis, and they're in and out on a minute-to-minute basis. So from that, look, it's a good business. It's a very solid business and well run, a lot of assets under management, nice track record. I would imagine they've got a big bonus pool, which is probably a problem. They like to pay themselves heavily, as do most listed businesses. But I've got no issues with them. And I think if we go into better markets, which I think we will do, especially with interest rates coming down, I expect markets to pick up. I think they're very well placed, to benefit from this. So 5 years is a bit hard to read markets, but they're a pretty good business. No debt, nothing, unless they mess it up completely. But I don't think their track records suggest that.
Wayne, would you like to add to that one on Coronation?
Yeah. Look, I've worked for an asset manager my whole life. Mm-hmm. You get good years and you get bad years. Coronation has proved themselves as an extremely competent asset manager over the decades, but they hit bad times every now and again. The funds go out, they get underperformance, but there's problems with all companies. It's a very, very good asset manager. Certainly, I would hold it in my portfolio for the next 5 years. And just to sort of emphasize what David's saying, I mean, we at a record high on our all share now. It's had a very good run. All asset managers really make money as a percentage of assets. So when the assets go up, they make more money. And the bull market should continue with any luck over the next 2 or 3 years. So, Coronation as part of your portfolio, yes, I agree. Maybe I'd also put some Investec in there for the same reasons. But yes, I've got no problems at all with Coronation.
Sorry, David, do you want to say that so we can hear you?
Well, 91.
No, 91. Yeah.
91, sorry. 91, yes.
Brilliant. We have a question here, and I want to take it before we quickly go on the ad break. Barloworld, they've had a cautionary out. I think they've renewed that cautionary. It says nothing, okay? So there's actually no telling. But I'm wondering if we could speculate. Is it worth speculating here? Yes, David.
There's talk of a takeover. And we can't get any information out of it. When the first cautionary came out, the share price ticked up very heavily. And subsequent to that, they've been absolute mum. And I can't even pick up rumors. The only rumors are that there's some foreign company wants to take them over because of their exposure to mining. And, they're a good look. Their history goes back about 100 years plus, and that, even though they're a much more reduced business now. But they're a very competent crowd, with exposure to mining and to building, with the yellow metal. So, but we don't know. I don't know. I can't speculate.
Yeah. It is a tough one. Would you advise, a viewer to buy the counter and wait that whatever happens may be good? It's just not enough information to even make that call. Wayne, I'll ask you.
Look,
yeah.
when you get cautionaries out on companies, there are sometimes opportunities, and I know lots of traders, when a cautionary comes out, they buy the company, or they act on it. But it's really option money. You must just remember that it could go south on you rapidly. And once again, the central theme: yes, if you want to do it, that's fine, but with a small measured percentage of your assets. Don't put everything you own into Barloworld on the hope that there is a takeover and the share price goes up on the back of this cautionary that's up.
Brilliant. So we don't have much time left.
If it doesn't come out, if it doesn't come around, this thing's going to fall all the way back.
Share goes down.
That's the danger. That's your danger. Okay. So, and the fact that they're talking for so long is a worry.
Yeah, I agree.
Anyway.
I agree. Well, gentlemen, more questions emerging here. We've got one that actually just came in, and they ask, please ask the panel if they would take profits in TBS, that's Tiger Brands, or keep it. Any takers for this one?
Look, I mean, I know Tiger Brands has got many value-added products where they actually, are well-known brands in the fast-moving consumer goods section. But, as I'm in investments longer and longer, I really don't like these companies that have either a full exposure or a very big exposure to primary agricultural products. These are just commodities. Can't really add much value. So I would take some profits.
Got you, David. Would you like to add to this one?
What Wayne's saying is that they make bread. They make peanut butter, which is true, because if you go look, that's what they do. It's either mealie meal or bread or black cat peanut butter, where they've got to buy the peanuts. There is a lot of commodity trading around this. But I just want to say I'm watching Chad Kruger very carefully. He's turning the company upside down. He's embarking on quite aggressive policies and strategies, but we don't know, no one knows where this is going to go. There's still a lot of toughness out there. But don't forget exactly what Wayne says. These are commodity companies.
Are there better FMCG counters here? If I think of AVI, RFG, maybe Lipstar here, David, better ones if somebody really is keen on the sector. Yeah.
Probably AVI type businesses, because I think if you look at the FCMGs, fast moving consumer, FMCG. I've got to get that right. FMCG. If you look at them, while they've got them, Tigers, and they've got a lot of them, there's still a very heavy reliance on some of the commodities that they produce, which is maize meal and peanut butter and so on. So probably if you want to go for fast-moving consumer goods, I like AVI very much in that. But then they've got the bloomin' fish, Why they got the
you can't believe it. Look, I mean, I don't think I'm ever going to buy another chicken company or another fish company. AVI, the fish is small, cannot understand why they still got I&J in there. Yeah. And their biscuits division, I mean, now David charges a packet of biscuits a day from them.
Oh, wow. Okay.
That's absolute truth. Yeah. I just sent my wife out to get some nutty crusts,
but those nutty crusts are really underrated. Really, really underrated. They're so good.
I eat the whole packet at a time.
Really, really, really good. I want to move on now to speak about some luxury counters. We've got a question here. Bernard Arnault, the head of luxury conglomerate LVMH, has reportedly purchased a stake in Richemont, the owner of Cartier. What does this mean for luxury counters? Does it mean anything? Or just, dipping into the competitor? Nothing too big.
I think he's taking a look in. the last couple of days, the watchmakers have come under quite a bit of pressure. Prices have been falling. And they also gauge us from the second-hand market. I don't want to say second-hand market, because that is it's a collector's market, is a better way of putting, particularly at the high end, rather than, Wayne does it in motor cars. And I mean, there's always very huge interest in some of these old models. And it's been under a little bit of pressure. And I think a lot of that has to do with China as well, who I think were the big consumers, and also generally a slowdown in consumption. But so, I'm surprised. Richemont has held up pretty well, but there is a bit of pressure on that side of the market. Not the other side that LVMH is involved with, and Hermes and all of those. But the watches have been under a bit of pressure.
I was just thinking about Richemont. I can't imagine, Rupert even looking at allowing his company to be taken over in that regard. I'm keen to get you. Nothing of the sort on the cards.
No, look, I don't think this is the start of a takeover. It would be such a huge transaction, and to get through competition authorities for these two businesses. So I think he's just, well, look at me, what do I know? But I think he's just taking a punt because it looks cheap.
Very interesting indeed.
The jewelry side's doing well.
Yeah.
That's where Cartier and Cleef & Arpels and all these businesses. So while watches, just to come back on the Richemont side, so while the watch side has been under a bit of pressure, and, for other watchmakers, jewelry's just, doing incredibly well. Those are the diamonds, that one that they found in Botswana, which is second biggest ever found. I mean, waiting to see what that goes at.
I must ask you if you think, smartwatches have given just, old school watches a run for their money here. The two markets don't even don't even collide.
No, that's like looking at LVMH. I mean, LV's bags and Shein bags, different.
Okay, not even comparable. Okay, let's talk about Bidcorp. They're out today. I think when I checked the share price earlier, it's doing super well. Somebody's asking if it's too expensive, just considering what a good business it is at this time. I'm wondering, has the easy money been made where Bidcorp is concerned? Wayne, let's go with you.
Yeah, well, look, I mean, Bidcorp's a great company. Obviously, the results were just fantastic. And, I mean, when I think back of all the companies that sort of I look at locally and overseas, I mean, there's literally, maybe there's 15 companies that I would truly classify as blue chip, and this is one of them. So I think no matter what the price is, I think you just buy. Maybe you slow down on your buying now, given what the price has done. But they've proven themselves. I mean, this is truly a South African success story, one of the only companies that went overseas and didn't, break the bank, essentially. I mean, SAB was the only other company that went overseas and made a success out of it. And Bidcorp.
Yeah, excellent management. I think, and it's not going to blow the lights out. You know what I mean? It's not going to. It's going to be. These are the kind of results you can probably expect on a continuous basis. They will always produce very decent. I mean, after all, that's what they do. They deliver food to restaurants and to canteens and hotels and those kind of things and that. But still, very well run, nice margins. Yeah, this is not going to be an NVIDIA or a Tesla or anything like that, but very, very solid business and good yields, good yields, good dividends.
This business was actually unbundled from Bidvest. I'm wondering if, Bidvest might miss that business within its portfolio, if it would have been better to keep it, because it is such a good business.
They needed that.
Yeah.
They needed to let Bernard run his business and local. This was the international business. And both have picked up the Joffy legacy, I think. And, there was a lot of DNA left in both of those companies. And Bidvest, in its own way in South Africa, still does very well.
And I think, just aside from all of the questions, this concept that Dave has brought up here of DNA left in a company from the people who found the company. This is so important because, it really leaves you with something to carry on with, because it's in the people's It's how they work. It's their ethics. It's their methodology. You look at ShopRite as well. You know, YT left a fantastic legacy there, a fantastic DNA. And certainly Brian Joffrey did the same at Bidvest and Bidcorp.
Very interesting indeed. I think a great perspective there. I want to speak about Adcock Ingram. It's come up here. Can the panel speak to us about Adcock Ingram? We don't hear much about South African pharmaceutical companies. There was a share buyback and even a dividend. Am I missing out?
I have to intervene at the moment.
Yeah,
We're talking about Joffrey.
Yeah.
And bless Brian. The one mistake he made
Was this one.
was Adcock Ingram, which 10 years ago they bought for 75 Rand, still trying to get the money back. So it's just opportune the way that it came in. But good numbers. I'll let Wayne continue, but I had to get that in.
Wayne, what do you think?
Look, I mean, I will be honest. I don't like the SA healthcare, pharmaceuticals, hospitals. I mean, maybe Life Healthcare looks relatively cheap, but the medical industry worldwide, unless you are a drug manufacturer and you're bringing out the new drugs, like David always goes on about the diet drugs, you know, unless you're in that field and you're a major player, if you're just providing a service to the private sector hospitals, but more importantly, to the government sector, you're just under pressure. I mean, governments worldwide are putting healthcare costs literally in their crosshairs. They are trying to get this down. And we've seen all the legislation that's coming to South Africa trying to control the cost of healthcare. And I think this is a structural problem that the industry's got. So I don't really like Adcock's.
Yeah, they made money, strangely enough, from the over-the-counter drugs, which are just going into a pharmacy or even online buying. And there was a particularly bad flu season. And I think that propped them up quite a bit. So, but it is, as Wayne says, you know, your margins are, it's a very difficult business for the hospital side and also for prescription side, because the prices are controlled and they leave you very little margin there. Yeah. Anyway.
I want to have one more question and then we'll move into stock picks. The prospects of lower interest rates in the US, would you invest in stocks such as Target, Walmart and Costco? Which one is the best? I see you nodding there.
Stock pick.
Yeah, okay.
That's my stock pick.
Okay, so then don't tell us.
Walmart. Yeah, that's, I'll tell you now, that's exactly
But what was your stock pick last week, David? Wasn't it Costco?
Yeah. Costco and Walmart. I think why I'm choosing Walmart for that very reason is I think that buyers are very discriminate at the moment. They're looking for bargains. And for that reason, I think as they get more money, they're not just going to be spendthrift. I think they'll be very careful. And, you know, Walmart, I think, is going to give Amazon a bit of a challenge. You know, on the e-commerce side, it's taken a long time, but I like where they are, and their last set of results were very good. And it's just one of these companies that I think you can just put in any core portfolio. And that, but it's exactly around that reason that, you know, I would recommend it.
Brilliant. I think then we might as well go away into your stock pick. Which counter are you going with this evening?
Well, I suppose we've spoken about it indirectly. Yeah. I'm going for Standard Bank. These banks do look cheap. They're single-digit price-earnings ratio or just in the double digits. Very, very high dividend yield that's not under threat. I know the Standard Bank and the other bank share prices have done quite well recently, but I'll still go for Standard Bank. It just looks good.
Well, guys, it's always fun talking to you. Thank you so much for covering us on Stockwatch this evening. And that's all for tonight's Stockwatch. Thanks to our guests, Wayne McCurrie from FNB Wealth and Investments and David Shapiro from Sasfin Securities. Up next at the close. Stay tuned.